Hello, I'm Paul Harris, America's editor at Mining Journal, and welcome to this Mining Journal exclusive interview with Peter Marrone, Executive Chair of Yamana Gold. Good morning, Peter.
Good morning, Paul. How are you?
Very well, thank you. How are you today?
Very well, thank you.
Excellent. Yamana Gold has arguably been one of the most active senior gold producers in the past year or so, with the spin out of Nomad Royalty, the acquisition of the Wasamachi property in Quebec, Canada, the integration of the Agua Rica project with the Alhambra plant in Argentina in what is now called the Mara project, and now most recently with the green light on the Canadian Malartic Odyssey underground expansion. With all those achievements, Peter, it was a great year. What are you most pleased about, and what do you think will have the most impact on the company going forward?
Paul, the challenge to a question like that is that it's sort of like asking a father, who is your favorite child? And I have so many positive things to say about so many of the things that you've mentioned, and then some. But I would say what excites me is what has always excited me about the company, certainly over the last several years: the cash flow generation, free cash flow generation, continuing improvement on all of the financial measures of the company, our ability as a result of that to meet our capital allocation priorities that include not only the sustainability of a dividend, but also the increase of that dividend. At the end of the day, however, I would say that a mining company is only as good as the resources that it has in the ground and the quality of its projects. And so in some respects, then we have to start from ground zero, from the basics. I'm excited that we once again increased proven and probable reserves well above what we mined last year. I'm excited that we have roughly 14 million ounces of proven and probable reserves in gold alone, in addition to the inventory of resources, and also, of course, silver and copper. But one of the things that perhaps from a momentum perspective is very interesting is what we've just announced, the Odyssey project. Odyssey is the underground at Canadian Malartic. And I'd say that's one that certainly should be very exciting, not only as a prospect, not only with the 14 million ounces that is already in inventory, with a very modest and conservative 7.4, 7.5 million ounces that would be mined over the next 20 years. I think that this is a generational asset, and we will be here for quite some time. What I find particularly interesting about that project and why it is exciting is that they have developed, and by they, I mean the mine operations management, delivering to the partners, and then the feedback between the partners and that operations management, what I think is an excellent, perhaps even brilliant plan that allows us to be able to capture more than 900,000 ounces of that underground as the underground is in development. The result of all of that is that at an even modest $1,550 per ounce gold price, not where gold is at today, more than 50% of the capex is covered by the cash flow coming from those ounces without negatively impacting the value of that underground. Finally, I would say that one that truly is exciting because it is a metal that we want in the portfolio. It is a green metal, something that certainly is relevant to electrification. And as the world continues to electrify, is our Mara project. You touched on that. We completed the integration of Agua Rica and Alhambra late last year. We're now advancing that project. I think that's one that is more unheralded than it should be. It should be garnering far more attention inside our portfolio because of the size and scale, again, generational, more than 3 decades of production with a production platform. I always think these things in pounds rather than in tons, but of more than 500 million pounds of copper production per year. Those are some of the things that certainly excite me as the prospects for this year and into the next several years.
Well, thank you, Peter. I want to touch more on Mara in a little bit, in a moment, but let's talk a bit more about Canadian Malartic. Canadian Malartic has been the biggest mine in Canada for many years now, and the Yamana Agnico Eagle partnership seems to be working very, very well. And you're looking at producing 500,000 ounces a year from the underground operation, and that's beating your previous thoughts that it would produce 450,000 ounces a year. So that's obviously a big win. The capital cost of that is, I think, $1.3 billion. And so to fund 50% of that from cash flow, I mean, that's incredible, isn't it? It's huge.
Yes.
And Odyssey is going to have like pretty much a 2 kilometer shaft, 20,000 ton a day hoist. I mean, we're talking some pretty serious sort of engineering, mining engineering technology. What do you think will be the biggest challenges to making Odyssey a success? And is there more
I would say
potential
that,
there?
yeah, potential, definitely. Let me start with that first. So as I mentioned, an inventory that is already in excess of 14 million ounces, but a mine plan that contemplates the mining of only about 7.4, 7.5 million ounces. So there's an excellent prospect for more of that to come into inventory for production, possibly for extension of mine life. As interesting is that the three deposits, the underground deposits, will likely continue to get bigger. So that 14 million ounces is likely going to become a number that is larger than that. So I think that makes it very, certainly very interesting, a great prospect. 545,000 ounces is the average from about 2028 onward for roughly the next decade to dozen years from that point forward. It's a very significant production platform. What I see as the challenges, short term and intermediate term, are the following. Short term, we have to do some of the construction work, some of the concrete work that relates to the shaft this year. That's a critical path item, because if we were to sink this shaft over the course of the next many years to that 1,800 meter level, as you mentioned, roughly 2,000 meters, we have to start that work this year, and it has to be completed in a timely fashion this year and into early the next year. In terms of the intermediate term, as with all things that are this size and scale, I would say that the critical path that needs to be dealt with, the risk, as you describe it, is making sure that we manage the health and safety aspects very effectively. Given the depth, given the size, we want to make sure that we manage the health and safety of workers effectively. We want to make sure that we've got proper ventilation. That requires its own heft and efforts in making sure that we do that effectively. The good news is that it's been done before. There are others like this in Northern Canada, in Quebec in particular, certainly in Ontario and other parts of the world. And perhaps even the better news is that we've got the skill sets inside the company to manage all of those challenges. On balance, then, I think this is more opportunity than it is risk. And that opportunity begins with, as I mentioned a few moments ago, the inventory in the ground, because that 14 million ounces is likely going to become larger, and the 7.4 million ounces that we will mine will likely become a bigger number.
Okay, thank you, Peter. In Argentina, let's talk more about the MARA project. You put a deal together to bring two assets together, and this also reflects on Canadian Malartic as well. You know, the partnerships and the collaboration between what in other moments in time are competing companies. That seems to be happening much more now than in the past, and it seems to be a key success factor. How important is that in sort of taking a project like MARA, being able to take that forward and benefit from the resources that are there?
Yeah. So again, a good question. And the way that we looked at MARA is we could develop Agua Rica as a standalone project, and it would be a very hefty and robust project. That 500 million pounds of copper production per year, the roughly 30 years of mine life, is entirely from the Agua Rica side of it, not from the Alumbrera side of it. Alumbrera has come to the end of its mine life. And so we could have looked at it and said, and we did, this is what we would have to do as a standalone project. What is the implication of all of that? CapEx is going to be greater because we have to develop our own plant, and it's a big plant, more than 120 million tons, 120,000 tons, my apologies, of processing per year. We have to spend the capital for that. We have to build it. We have to recognize that there are challenges in the development of those sizes of projects. The challenge is the risk to times, schedules, and to CapEx is not the mine. That's just opening up. It's the stripping of the overburden. It is the plant. And so the conclusion that we reached about 1.5 to 2 years ago is, why don't we negotiate an arrangement between the partnership of Alumbrera? We are a partner of Alumbrera, a minor one at 12.5%, or we were. We're 100% of Agua Rica. Let's combine the two projects. Combine all of that infrastructure, the plant, pipeline, ancillary buildings, tailing storage facility with the Agua Rica project, it creates an entirely new project. The capex is a fraction, literally a fraction, likely one half of what it otherwise would be. But in my view, more importantly, it eliminates, and if it doesn't eliminate, certainly significantly reduces the risk for that size and scale of project, because we don't have to build the plant. That plant is built, that infrastructure is there. We do have to make some modifications and retrofit, but based on feasibility level work, it appears that the ore from Agua Rica can be taken through the plant at Alumbrera better than the Alumbrera ore, which means that this provides us with an excellent opportunity. We give up some of it. We own 56.25%, not 100%, in order to make the deal happen. But there is value to those ancillary buildings, plant, infrastructure, pipeline, and there's value also to the fact that we don't have to worry about some of the permitting aspects, because some of the permitting is already complete.
Okay. Now, with Mara, as you mentioned, 500 million pounds a year of copper. It's copper in a gold company. For some investors, that's a bit of a clash, or a bit of a clash of personality, should we say? But it is a trend within the gold sector that gold companies are increasingly becoming copper producers as well. Why do you think that is? Is it because copper projects tend to have a longer life than gold projects? And after all, you're looking at a long-term sustainable business, a long-term sustainable dividend. So having longer life assets, does that naturally mean you have to turn towards copper gold assets?
Well, let's look at the production profile of that project. There is also 110,000 ounces of gold production coming from it, in addition to copper. So there is a significant component of gold coming from that asset as well. Clearly, the robust aspect of the project, what drives its economics, is copper, to some extent molybdenum, to a lesser extent gold. But we can certainly take advantage of some of that gold content. I agree with your assessment. At the end of the day, cash flow is cash flow. At the end of the day, it should matter less where it comes from. We would still be a very significant and dominant gold producer with our precious metals content on a gold equivalent basis between gold and silver of at least 1 million ounces. And that is increasing in the next several years to roughly 1.2, 1.25 million ounces. So we're still a very significant precious metals, and in particular gold producer. So having some copper content in the company is not and should not be offensive, because it should be a positive to be delivering those cash flows. But the important thing at this juncture is that we have not made that decision at this point. We're looking at Mara as a value driver, as a true value proposition. Copper is at $3.80 per pound, Paul. The studies so far have been done at $3 per pound of copper and $1,300 per ounce of gold. And again, gold is at $1,800, and copper, as I said, is at $3.80 per pound. But even at those more modest metal prices, the net asset value of this project is just over $1.9 billion. And on our 56.25%, that implies roughly $1.1 billion of value. That is not reflected in our share price. It's not reflected in consensus analyst models. And so we see the value play here, initially at least, is to continue to advance the project. The project is working toward a feasibility study that the three partners, Glencore, Newmont, and ourselves, are completing. Clearly, we're taking part of that lead because of our more than 56%. We're also going through the permitting process, and that will take us the next couple of years. As we go through all of that, the project will advance, the project will begin to garner more attention, and the project will also come closer to that net asset value and possibly even exceed that net asset value. I don't like to throw numbers around, but at $3.80 per pound of copper and $1,800 gold, given the sensitivity, that project has a net asset value that is closer to $4 billion. So these are big numbers, and our view is the best way to deliver value for our shareholders is to continue to advance the project and to evaluate what is our path forward, how we intend to manage that investment going forward. And finally, let me say that while we have as an option the development of the project, where we continue to own that 56%, the other end of the spectrum is that we could sell some portion of it, perhaps to finance our portion of the capex, And it hasn't escaped us that given the robust copper market that we're seeing, that perhaps there's an opportunity to say that Yamana can have a little bit of its cake and eat it too. Were we to create, for example, a copper company, using this as the heart and soul of that copper company, where we might have a share position in that company, take it public effectively. We might also have a gold position in that company, perhaps taking a gold stream coming from that particular asset. And that would be more consistent, coming back to the point that you raised, with some investor expectations that we should have more gold than copper. So were we to engage in that type of a transaction, which I think is very doable, then we would find ourselves in the position of having a share position in a very robust copper company with a robust asset, possibly with payments that would include gold coming from the gold component of that asset.
Okay, well, it's healthy to have various options. Now, in terms of Wasamachi in Quebec, in Canada, that's a gold project, which you recently acquired from Monarch Gold. How do you see that fitting into the Yamana portfolio? How do you see that growing into the Yamana company?
Well, Paul, we have a feasibility stage project. The Monarch Gold completed a feasibility study just 2 years ago. So this is a freshly minted feasibility study. And I appreciate that there's a natural tendency on the part, perhaps, of investors, certainly mining companies, to be a bit more dismissive when a smaller company completes a feasibility study versus a larger company. But we looked at the feasibility work that was done, not just the study itself, but the groundwork that led to the study, starting from the ground up and rebuilding the resource model. And our conclusion was that there was a considerable amount of heavy lifting that had been done. They'd done a great job on the completion of that feasibility study. So now we're looking at it and saying, what we have as an obligation, what we have to do, is to update that feasibility study and put our imprimatur on it. What do we know from our experiences at Jacobina, from Canadian Malartic's underground, that we can apply that skill set, that experience, to improve the project, to optimize it, to make sure that the costs are right, that the capex is right. And we've undertaken to get that done by the third quarter of this year. And we might be able to get that done a little bit faster than that. But in the meantime, we have a feasibility level project of a good, high quality feasibility study with more than 1.8 million ounces already in inventory as proven and probable reserves, and resources on top of that. We have drilling only to a certain depth, roughly 800 meters. So no drilling has occurred below that level. It gives us at least 14 years of mine life at a production platform of between 150 to 180,000 ounces per year. And it gives us the ability to do that at an all-in cost and cash cost that is below our average. So we're very comfortable with the project. What it does is it gives us yet another mine that fits very nicely geographically where we want to be in terms of size and scale, and that gives us a very decent growth, takes us to that roughly 1.25 million ounces, and the capex that's required for it is comparatively modest. That's what Wasamachi delivers to us.
Okay, do you see other consolidation opportunities for Yamana in Quebec or elsewhere? You know, similar things elsewhere.
And that's a tough question. Let me address it this way. Our purchase before Wasamachi was Canadian Malartic in 2014. So it's not as if we're looking at things, well, we're looking at things, yes, but it's not as if we are saying this is something that we have to do on a regular basis. It's very opportunistic. And one of the things that I haven't said that is critical in the assessment that we make is, does the potential acquisition deliver a return on investment? We're investing an amount to buy it. We're investing an amount to build it if it's a development stage project. We want to be able to demonstrate that we can deliver a return on that investment that is certainly at a significant premium to our cost of capital. And we prefer a multiple of that cost of capital. And what that implies then is that those transactions are few and far between. Canadian Malartic definitely meets that hurdle. We've certainly been able to deliver a return on invested capital that has been very robust, certainly into the double digits, likely even into the teens. And now that we have got this Odyssey project, the underground, which we knew something about in 2014, but we've been maturing since, I think that gives us an even better case to make for buying things in order and with the objective of delivering a return. Wasamachi does that for us as well. It delivers a return that is into the double digits at a deep discount to the current spot gold price. And so those are some of the challenges that I see in consolidations more generally, that while the transaction might be accretive, if one is using stock, it might be accretive on different measures, cash flow, free cash flow, on a net asset value basis, accretive to your stock versus their stock. At the end of the day, if we're paying cash or if we're paying in stock, we're paying a purchase price.
Yeah.
And we need to be able to demonstrate to our shareholders that we can deliver a return on that purchase.
Thank you, Peter. I'd like to go back, I'd like to change tack, but also go back to Canadian Malartic. Odyssey will feature all-electric underground mining fleet with the aim of minimizing its carbon footprint. And you recently announced a climate change strategy for Yamana Gold. So what do you estimate Yamana's greenhouse gas emissions are at the moment, and what's your plan to reduce those and reduce its carbon footprint going forward? What are the goals and investments you're making to that end?
Yeah, so another very good question, and let me begin by answering the factual questions. Based on information that we publish, we're at a point of roughly 200,000, last year a bit lower than that because of some lessened activities because of COVID-19. We were at about 180,000 tons of carbon equivalent emissions at our wholly owned mines. Canadian Malartic is a big open pit, has a bigger footprint. And so that alone generates about another 200,000 tons of carbon emissions. But I think we need to put that in context. If we look at, let me pick an industry, not for the sake of throwing stones or eggs or making aspersions, but if we look at the airline industry, even a mid-size national and international carrier, its carbon emissions is closer to 14 million by comparison to our 200,000. So it's about 70 times the number. So we need to be sensitive to what these numbers, they sound like big numbers, we need to be sensitive to what these numbers mean in the grand scheme of things. But we're taking this seriously. And so to go to your question, last year we reduced to the year before, so in 2020 comparison to 2019, we reduced our carbon emissions footprint significantly, in the range of 13 to 15%. We reduced it the year before as well. The year before that, there was an increase. And the reason why we had an increase is we had a new mine. Our Cerro Moro mine came into production. And of course, globally then, in terms of the aggregate, that increases the overall carbon footprint of our company. So what we've done now is we've said, we are adopting a climate change policy, and we're adopting a climate change approach. Aspirationally, we expect to get to zero emissions by 2050. On an interim basis, we will adopt a science-based approach, so science-based targets that get us to no more than 2-degree increases, which is consistent with the Paris Climate Change Accord. And what we've indicated is that we will take this science-based approach, looking at it from the bottom up, from the ground up, engaging operations, technical services, exploration, our finance teams, in terms of how we build a new mine so that it has lessened the carbon emissions, and where we have existing mines, how we reduce that carbon footprint. This year will be a planning year. And so in that planning year, by the end of the year, likely during the year, but certainly by the end of the year, we will have outlined all of our goals. So rather than on an ad hoc basis, these are the steps that we take, how we improve, for example, our milling, the efficiencies and optimizations of our plants, what we do in terms of ventilation, how we connect in certain cases to the grid, and what the power generation of that particular place is. These things that we've been doing on an ad hoc basis, we're saying now we're going to take a holistic approach. We're going to start from the ground up, engage every part of our company. This year will be that planning year. We are confident that we'll be able to get to that 2-degree goal with science-based targets. Aspirationally, we expect to get to zero emissions by 2050, and we'll demonstrate the path that takes us there, beginning with this year with that planning. So rather than ad hoc and demonstrating year over year some reductions, and recognizing also that we have new projects and new mines that are coming into the pipeline, what do we have to do now to plan so that we're not emitting greenhouse gases?
Thank you, Peter. I guess there's the whole situation will be a lot clearer after this year once you've gone through this planning cycle in terms of what the potential capex might be related to energy projects. But going back to sort of M&A within this context, it sounds like it will obviously inform the company's or potentially future acquisitions or acquisition strategy. It sounds like the local energy matrix, whether it's hydro or coal-based, for example, that'll become one of the decision factors when you're assessing potential acquisitions. Or conversely, as part of a development project, you might have to consider building out renewable energy sources, whether it's solar, wind power, or what have you, to compensate to not use local carbon sources or things of that nature. So this is going to be quite far-reaching for the company, isn't it?
Very, very much so. And you touched on something. If I were sort of to deconstruct some of what you have said and the implicit questions, some of it is outside of our control. When I gave those numbers on the carbon emissions, I'm including both direct and indirect. And on the indirect, it's the power consumption and what's the source of that power consumption. Quebec is an easy one because almost 100% of its power comes from renewable hydroelectric. There are parts of the world in which companies operate where there's more of a dependence on other things. Argentina is a country where that dependence includes natural gas, just as an example. So there we have to look at alternatives. And part of that alternative is wind power. Part of that alternative is solar power. We happen to be blessed in some respects because we are in parts of the world where there is constant sun. Our El Peñón mine is an excellent example of that. It doesn't feel like a blessing when you're there at Cerro Moro because the winds can be very biting and it's an impressive wind chill, but there's a considerable amount of wind. And so we need to consider whether or not wind power is something that we can consider. Cerro Moro presently is not connected to the grid. That's another option available to us. And we've already outlined that plan. What's the capex for it? And what we would have to do in order to connect to the grid. So at a minimum, then we would be not reliant on diesel power, and we would be reducing our carbon footprint just by connecting to the grid alone. So we're looking at all of these things, but as I said, it has to be from the ground up, and it has to engage all disciplines in a company. Otherwise, it becomes ad hoc, and one does not. If we're to set out goals, we want to make sure that we can meet those goals. And so if we're saying to you and to others that this is the target for the year, we're expecting to be able to meet that target. And the only way to do that is to say involve every discipline of the company and build it from the bottom up.
Okay, thank you, Peter. And finally, and this may be the toughest question of all, given that all the different things that are going on at Yamana Gold, what are you most looking forward to this year?
I'm going to struggle with that question because, again, I go back to what I started with, which is, who's your favorite child? And in answering the question, it's almost implicit that I'd be saying that this is one that I favor more than others. But I'd say, as an investor, let me look at it from the lens of an investor. I think it's important to demonstrate momentum, but I think it's equally important to demonstrate steady state. And steady as she goes. So I think one of the things that perhaps does not come across as exciting, but that is and should be exciting, is the continuing generation of cash flows and free cash flows in a company, and that is true for our company. We were able to improve our balance sheet significantly last year. We ended the year with more than $430 million in cash in our treasury. That number will continue to improve this year as a result of the generation of cash flows, more importantly, free cash flows. We increased our dividend by more than 450% in an 18-month period to the end of last year, including an increase in the fourth quarter of last year. I'm confident that our board of directors will come to the conclusion that with those increasing cash balances and very robust cash flows, that we'll be able to do that again, continue to increase the dividend this year. In terms of momentum things, we've touched on many of those, and those are things that do continue to excite me. We've indicated what we're going to do with the Odyssey project at Canadian Malartic. We've already indicated what we plan to do with our Jacobina mine. What I think is very interesting, and while we touched on it, I think is very interesting, what's the plan for Wasamachi? Because I think once we deliver that plan by the third quarter, it will become very evident that this is a very robust project. We bought comparatively inexpensive ounces, and we're able to deliver another mine from it.
Excellent. Well, that's what we've got time for today. And so I'd like to thank Peter Marrone for joining us today. And goodbye from me, Paul Harris, and stay tuned for more Mining Journal interviews. Thank you very much, Peter.
Thank you, Paul.